not just with the Money Show, but with an amazing group of investors. We're live to several different platforms here. Wherever you're tuning in from, feel free to go ahead and give us a like, comment, share. This is going to be an amazing one. There's a lot to cover today. So Mike, I'm going to turn it right over to you to outline a little bit of the vision and then start working our way around the room.
Great. Thanks, Gav. Welcome everybody who's watching this. We're trying a new format, a little something different this month. We've been doing the audio X spaces before our events, but this time we want to give you a little taste of what our people are seeing in the markets. They can share screens, they can share charts, things like that. It's going to be a great hour and a lot to talk about, as Gav mentioned. We're a couple weeks out from the Orlando Money Show, the Traders Expo, where all of these people that are joining the live stream are going to be speaking at, sharing their market thoughts, answering your questions and all of that. But you really couldn't ask for a more potent mix of market forces out there right now, right? We have gold and silver that just had the best quarterly performance, essentially on record. We have the stock market that's trying to shrug off this, this government shutdown risk, and you're going to see some great stats on the history of shutdowns and what they mean for stocks. You've got interest rate concerns, kind of the Fed being challenged in ways it hasn't been in the past. At the same time, it's starting to get back into the interest rate cutting scenario. So a lot going on, a lot of opportunities, some risks that seem to be growing. We can even talk a little bit about AI and the bubble boom debate there. So it's going to be a great time. Thank you for joining us. And I'm going to, again, just kind of go around the table here, give everybody that you're watching a chance to talk about what they're seeing in the markets and, their part of the markets that they focus on. And I do want to kind of start with Jonathan, with Capitalist Pig. Jonathan, thanks again. I've had a chance to chat with you at past Money Show events. You really had some great observations. I'm still going to congratulate you on the platinum pick that you had in Miami, which started taking off like within 48 hours. So good on you with that one. What are you seeing in the stock market here as we start the fourth quarter? You muted.
Yeah, we'll just tap that unmute.
Mike, thank you. It's great to be with you, and I'm excited to be with not only our illustrious panel, but all of our viewers who will be joining us at the Money Show later in October. And because the Money Show is so traditionally full of active investors, and I think it's a real glory time now to be an active investor. The real danger that I see right now, ironically, lies in this so-called diversified S&P 500. When I was getting into the game, it was always told, you recommend the S&P, you're going to get 500 stocks. And, with that concentration of the top 10 stocks in the S&P 500, I believe, unless someone on the panel can correct me, accounting for something more than 50-60% of the entire index. That's a historic high that historically is tended to mark a turning point in terms of market dominance and market concentration. So I think it's going to be a great time for active management in the next 18 months. I'm thinking somewhat not unlike the period of, say, 2001 to 2010. The indices were relatively flat. I mean, Microsoft was an index name, Oracle. Those were dead money for those periods of time. But there was lots of money to be made in precious metals. There was lots of money to be made in international stocks in particular, which have outperformed year to date. So, at capitalistic.com, I'm really focusing on active management with alternative ideas. And I think now is the time more than ever is to focus on those alternative ideas, not be picking tops or trying to catch falling knives when they eventually do start to come.
Got it. Appreciate that, Jonathan. Jason, I want to pivot to you because, again, I've been following the work that you do at Money Flows, and you guys have had some great calls talking about things like the rotation into small caps, the fact that when you do get these really powerful moves, you've seen big money continue to drive markets higher. There haven't been a lot of those sort of worrisome signals that you guys key off of. So why don't you just sort of briefly summarize where you're at and what your research is showing?
Yeah, sure. So we have a confluence of really positive tailwinds that we're witnessing on our side. From a macro level, we obviously have rates finally lowering for the first time. We have anticipated additional cuts for even this year and throughout next year. That's obviously very bullish, especially for small and mid caps. We have lower taxes with the big, beautiful bill that still has to work its way through systems. And this is, again, beneficial for small and mid caps. If you get that double whammy, lower taxes and lower rates to refinance your debt, they're typically the more debt hungry areas to finance their growth. That's very bullish. We're about to enter in the seasonally strongest period of the year. So we've done studies going back since 1990, monitoring all equity markets, October through December. It may not come as a big shock and surprise that it's a huge seasonally strong period of time. October is strong about 65% of the time since 1990, but November and December, 74% of the time each. November is seasonally the strongest month of the year by far, with excellent returns equity. So you stack all these things on top of each other. And then we add in what, we've been monitoring earnings. So second quarter earnings as reported through the third quarter, according to FactSet, 81% of the S&P 500 beat revenue estimates, 81% beat earnings estimates. So that trounces the 5 and 10-year averages. So we see a lot of tailwinds, really positive for small and mid cap stocks. And we're particularly, bullish on tech, discretionary, and industrials, which are kind of the sectors that really fuel a bull market. So that's what we're seeing on our side.
Perfect. Thanks, Jason. Faust, I wanted to go to you again while we're still kind of focusing on the equity markets. I mean, you and I had a chance to talk in Toronto about how things were looking back then. I find it fascinating that September was supposed to be this month, in August even, we're seasonally weak period of the year. Everybody hide under your desks. We got problems. And we had the best September for the S&P in 15 years or something. Now it's October is volatile. You got to watch out for that. What are your thoughts? What are you seeing here?
Well, I'm seeing is that, going into September, October is probably one of the best months of the year to trade going to December. Now, I know we got this shutdown, but as day trading is going, what we're seeing a lot of big actions going on with the quantum stocks, and also nuclear stocks have been doing really, really well. Tesla has just been busting through new highs today. It's just doing phenomenal, $15. I mean, we've been really focusing a lot, which I don't know if anyone really knows as day traders, a lot of the high yields have been doing really well. There's a lot of these new yields that came out that end in Ys, even that are piggybacking off the options. And there's these weekly yields that they pay you, high yields. They've been doing great. I think they have a lot to do with a lot of the action that's been happening with these stocks too. Now with the shutdown and everything, I know we'll talk a little bit about that. Listen, as long as this thing gets done sooner than later, the market's just doing great. I mean, from opening up negative this morning, we're already positive. So as a day trader, I'm seeing a lot of buying. News came across. I don't know if anyone saw it. Intel just cut a deal with AMD. Stock just took off. It's up about 6% right now. So I don't think people are shying away from it. I think we're still looking very bullish for the market for the next 2 months, as long as this shutdown gets done.
Perfect. All right. Thanks, Fausto. I got to go to Peter now. I appreciate being patient, because it's funny. I mean, it's not often that you think of gold and silver as the star of the show. Usually people, I guess the common narrative is, it's just something you got to own for, chaos and bad times and so on. But obviously that hasn't been the case. I mean, we've seen an incredible rally, not just in the third quarter, but for the last year and a half, 2 years. What's driving that? What are your thoughts on where we stand now in the metals market?
Yeah, well, you guys are very complacent in the face of what is an ominous warning. Gold is not just, another commodity, and it's not going up because there's a big spike in jewelry demand. Gold is a monetary metal, and, gold has doubled now in the last 2 years. And, last quarter it was up, I think, 17%, silver up 30%. I mean, silver's at a 14-year high, not quite a record high, but it's on a big move. And it's just the whole metals complex you mentioned earlier. Platinum is actually the metal that's moved up the most year to date, up over 70%. But there's a reason that precious metals are being bought, and now mining stocks, which have more than doubled on the year. I mean, the gold stocks are the best performing sector, way outpacing even tech. You've got, maybe 125, 130% gains year to date in, GDX, GDXJ. But what's driving this? I think it's a massive vote of no confidence in the U.S. fiscal and monetary policy. What you're seeing is the beginning of the complete de-dollarization, I think, of the global economy. The dollar is going to lose its key status as the primary reserve asset. And that means that we are headed for a crisis in the United States that will make the 2008 financial crisis look like a Sunday school picnic, because this is not going to be about mortgages. This is going to be about U.S. sovereign debt. And that's what is going to collapse. You're going to see a mass exodus out of treasuries, out of U.S. dollars. That's what's starting right now. I mean, that's why gold is going up, because foreign central banks have been selling dollars and they're buying gold because they want gold to be their primary reserve, not the U.S. dollar. They're not going to be buyers of treasuries. And now Wall Street is finally getting in on it. They've woken up to what's going on. I saw a week or two ago as Morgan Stanley tweaked their 60-40 portfolio. It's not 60% stocks and 40% bonds. It's 20% bonds and 20% gold, which means if Morgan Stanley clients are going to follow that, advice, they got to sell half their bonds. It's a massive sell signal on bonds and telling people to buy gold. So I think this is the beginning of something really big. It's not the end of something, but it's also going to take down, the U.S. economy and the American way of life, because we've used the dollar's reserve status as a crutch. That's what enables our economy to function. That's how we can consume so much without producing. That's how come we can borrow so much without savings, because the rest of the world does that for us because they wanted our dollars. But when they don't want our dollars anymore, when they want to get rid of our dollars, that means we're going to see a substantial increase in the cost of living, a substantial increase in long-term interest rates, and a dramatic decline in our standard of living. Because we're not going to be able to live beyond our means anymore. We're not going to be able to consume stuff unless we can produce it. And we don't have the industrial capability anymore to produce the stuff that we import. And we don't have the savings to finance all the debt, certainly the government debt. And I think what's really driving things now, too, is not just a big, beautiful bill, which showed the world that there's no way we're ever going to get our fiscal house in order, because whatever big spending we had under Biden, it's now worse under Trump. But now Trump is also stacking the Fed with his cronies, demanding that we cut interest rates, even in the face of inflation that's way above the Fed's target, but more importantly, headed in the higher direction. So inflation is above target and heading higher, yet we're getting rate cuts. So that means 2% inflation now is no longer, something that the Fed is targeting. Who the hell knows what the target is now? They don't even have one. It's probably the sky's the limit when it comes to inflation. And so, that's a huge sell signal. I think we're going to start to see a much weaker dollar in Q4 and then all of next year. And that's, I think, going to drive gold prices even higher. And I think more significantly, bond prices lower. And that's probably what's going to result in a new QE program next year that is going to be a big disaster, because that's just going to fuel the fire when the Fed starts to go to QE and inflation is just going to soar. When under Biden, the worst year for inflation under Biden was the first year. And that's because it really got started under Trump with all the COVID stimulus. But inflation, even though it was high under Biden, it came down over the course of his presidency. For Trump, the lowest year, the lowest inflation is going to be his first year. Yeah. It's going to be at the highest at his last year, and it will be in the double digits. So people were, upset about inflation under Biden. It's going to be way worse under Trump.
There's a lot to unpack there, but I want to make sure I get to finish going around the room before we circle back to some of those points. Honestly, you've been very patient here, and I appreciate that. When it comes to the oil markets, especially in a commodities environment where other commodities in the base metal space, even the precious metal space, have done very well, energy commodities haven't performed. So can you set the stage? Why is that? What are we seeing in terms of supply and demand that's sort of weighing on pricing domestically and globally in the energy markets?
Is that a question?
For honest, yes.
One of the problems we have today that between fake news from the media and bad forecasts from the bank and the International Energy Agency, things are really bad. We never seen something like this before in the oil market in terms of a combination of these things, in addition to the issues that I'm going to talk about during the conference on the increased volatility from sources that did not exist before. So if you look at the IEA forecast, one of the problems we have, what we call circular information, which means that if the data is bad from the IEA, and the banks are depending on the historical data from the IEA, then everyone is wrong. And the IEA being wrong on global oil demand for 18 years in a row, literally 18 years. So if everyone collecting the data over 18 years and using it to do the forecast, and then the IEA come in after 15 years and say, well, sorry, I was wrong, then everyone is wrong. So that's number one. Number two, one of the issues that analysts are missing from the market, and it's a very interesting development, that everyone knows that the oil market is not competitive. It's never been competitive. But at the same time, there is no cartel. It's some sort of oligopoly. And most of the models basically are kind of oligopolistic models. That is a big problem. The reason why, because since 2016, China entered the market as a big buyer. And therefore, the market changed completely. The market structure changed completely from oligopoly to oligopsony. And therefore, all those models at the banks are completely off. I'll give you an example from today. China been building its inventories. We have two problems. I mentioned earlier, fake news on one side and bad forecasts on the other. Bloomberg and others been telling us that China been building its inventory significantly and supported prices. Well, most of the increase, well, not most, but a large portion of the increase in inventories came because of adjustment, because there were certain facilities not being looked at before, and then all of a sudden we found them, so we made the adjustment. It's not an actual increase in inventories. So that's number one. But number two, we've seen this behavior from China since 2016. Buy low, sell high, period. So what happened? They've been building those inventories. Bloomberg been telling me, oh, they will continue doing this until the end of 2026. Guess what? They've been withdrawing from the inventories. They lowered their imports significantly. And that usually at least prevent prices from going up. But what we've seen the pressure on prices simply because of China. So China right now is literally reducing imports, which means that reducing global oil demand and withdrawing from its own inventory. So we have a power in the market from a buyer, and that power could be way more than OPEC and OPEC plus.
Got it.
And that's really the major change in the market.
Perfect. Thank you, Anas. And just as a reminder, we are going to have all these gentlemen. You're going to be able to learn from them at the Orlando Money Show. It's coming up October 16th to 18th. Gav will put a link up there during this chat. If you need anything, you can get some more information there. We've had a chance for everybody to sort of speak on their sectors and give a big picture overview. And now I want to drill down a little bit more, pardon the pun there. Jason, I'm going to go to you because you did mention and tease some of that research on market or government shutdowns and market impacts. And I found it pretty fascinating myself. So why don't you, I don't know if you have something you want to put on screen or if you just want to kind of like talk over your points there, bring that up because I think it's important people realize on a day that we're doing this when the government has just shut down for less than 24 hours.
Sure. I'm going to share my screen here and let's go over to a study that my colleague Lucas put together at Money Flows. So what everyone should understand about Money Flows is we're pure quantitative. We don't, pontificate and hypothesize too much. We go on the basis of historical and implied data, and we have a 35-year data set. So one example of what we're able to do, in this case, it's more than 35 years. Lucas studied all government shutdowns since 1978, and hopefully you're seeing it on your screen. What we can see is the S&P performance on the day of the shutdown, 1 week before the shutdown, 1 month, 3 months, 6 months, and 12 months after. And I don't know about any of you, but I certainly don't see anything that causes me alarm. Obviously, I'm not minimizing the shutdown or its impact on people who earn their money from the government and its potential impact on their paychecks and any sort of fallout. Essential services should continue. I'm flying on Monday, so I certainly hope air traffic control and FAA is all in their seats. But all I'm saying is from a stock market perspective and investment portfolios, it's kind of a nothing burger. It's a news headline, media driver, clicks, eyeballs. But from what we see, the forward looks very promising. And then again, if we stack that seasonally strong period of time, I think Fausto brought that up as well. There's a lot to be excited about. One thing I wanted to mention, let's see if I can move back here. One thing I wanted to mention is Peter mentioned inflation is moving higher. And while that's true on a month-to-month basis, I think it's really important to look back at history, because while the CPI reading, the latest reading was 2.9%, well above Fed Chair Jerome Powell's 2% target, our data using Bureau of Labor and Statistics data, BLS.gov, we went back since 1960. So the 65-year average of CPI is actually 3.75%. And rarely, if ever, was it below 2%. So while 2% may be the sort of stated guideline or the stated target, it's a bit of a unicorn. It's really hard to achieve. It's never really been achieved for any duration. And we're sitting well below the 65-year average of CPI.
Yeah. Remember that the only reason they came up with this ridiculous 2% target was because we were below it. And they wanted to justify creating inflation. And so they said we need more inflation because we're below 2%. But of course, the only reason we were below 2% is because the CPI is rigged. In fact, when you went back and looked at the CPI data, when you were looking at the CPI data from the 70s and the 80s, it was completely different methodology for computing it. And in fact, if we use the CPI that we used back then, the official inflation rate would be about double. So if it's 3%, it's actually 6%. So we never were even close to 2%, but it was just a pretense that maybe gave some people a false sense of confidence in the Fed. But my point is that that sense of confidence is going to be completely lost. And we're going to be having double-digit inflation. I mean, high inflation is going to be an economic reality in the United States because there's no other way that the government can pay its bills other than by creating inflation. And so that's why inflation is going to be, the sky's the limit, because the alternative to double-digit inflation is probably default on U.S. Treasuries, because interest rates are going to rise to such a degree that there's going to be no way for the government to legitimately pay the interest on the national debt, let alone repay it. And so the only way that we could survive without default and a major financial crisis is massive inflation. But then that just creates a dollar crisis that I think will be even worse. But that's where we're headed.
I got to jump in on that dollar point, and especially because, Jonathan, I know one of your points that you had made in previous appearances was that this is the time to start looking beyond the U.S. borders, look at some of these, foreign markets that have underperformed for so long, and everybody just wants to be Mag 7 all the time. Talk about what you've seen this year. I mean, I could put the chart up here, but we've seen, dramatic outperformance of foreign markets despite America First policy or whatever you want to call it. So why is that happening?
Yeah,
what do you see moving forward?
Had underperformed up until this year. I mean, owning foreign stocks has been a great way to play that weakening dollar. And I have to say, Mike, I think that is a trend that can continue. I mean, it's funny. We see the market, the longer many of us have been in the market, we see these cycles come and go. And, there was periods of time in which foreign markets far outperformed U.S. markets. I mean, that's why they came up with they coined that term BRIC, BRIC. It was a kind of easy way to kind of highlight these highly accessible or highly growing, fast growing markets. So I do think that now is an opportunity for not just foreign, but what they call frontier markets and emerging markets writ large. I mean, you have to look at for the big moves. You want to try to play a big move, but they're so undervalued relative to the S&P and relative to where they've historically been. I think that if you're not a day trader, if you're looking legitimately 3 to 5 years out, international and foreign are going to be winners.
Yeah, perfect. Fausto, I want to go to you next because you talked about some of the things like just while we're on, Intel's popping on this news of AMD. Obviously, the government's has gotten involved with Intel. And that's not the first time that's happened. We had the lithium company up 35% this morning on another stake there. How do you trade in this kind of environment where you're seeing more of that sort of government involvement in the markets and the stuff can come out of left field? I don't know what you do as a trader, right?
Well, it's funny you say that. We're talking about all these presidents and how we react to it. But let me tell you, this president obviously has done more volatility in this market than I've ever seen in my 35 years of day trading. I mean, the promises that he's making, he's actually keeping, and the market is very careful about what happens. So like here are all these deals coming into play every day. Like something happened, it would make the market run. So I mean, like, we're keeping an eye on a bunch of them that's moving right now. But if you talked about, Bitcoin, for example, I mean, we've been trading a lot of the ETFs of Bitcoin. They're running. Even just what happened just a couple of days ago, they were talking about how Bitcoin, Peter's talking about gold and making a big run. I mean, a lot of this, there's a lot of the ETFs that are running because of it, because of the inflation is coming in. So I mean, one thing about being a day trader, we're like the Marines, that go in first and we see what's happening. And then it just trickles down into like a week to a month to a year down the road. But it's just what I'm seeing right now is, as a day trader, is just like there's nothing that's pushing it down. I mean, other than everything just keeps going up.
And we're on the subject of trading, and you mentioned some of the ETFs, the yield max type ETFs that have really been rolling out left and right. You've got a market where some of the platforms are, not just offering you trading and 0DTE options. Now they're tied up with prediction markets and all of that sort of thing. How, as an investor or a trader, I guess, first timer or experienced, how do you approach there's more of that sort of gamification and the blending of the lines between speculation and financial markets and non-financial or prediction markets?
Well, obviously, that's why we're here at the Money Show, right? You got to get educated. That's like the most important thing. Everybody's got to learn how to play the game. Everyone's got to understand, what is your style? If you're a futures trader of options, you have to understand how they basically all work. A lot of people don't even understand what a bid and offer is. They don't understand what a spread is. They don't understand what, they think is reading the chart and indicator is the most important thing. And it's really not. I mean, sometimes you can't even get these stocks because the spread is so wide and the tier size is so small. I mean, I do a lot of presentations for NASDAQ, for the purpose of teaching people how to, and I'm going to be doing a lot of this at the Money Show, where just have to know how to use total view. I mean, just understand how orders are actually, how you see your order. I mean, people don't understand that you have a seat on the exchange. It's direct access, and with direct access, you could actually, with the ECNs, you could place bids, you could place offers. But when it comes to like our style of like the way we trade, we kind of just trade strictly momentum. I mean, we look at the momentum, we see what's going on, and just every day is an adventure because there's always something that is in the small cap that's moving, and there's always something new that's running. With some of you great guys and analysts out there talking about that are making certain stocks in an industry that moving. So it's not only just one stock that moves, it's a whole industry. We're talking about, I mean, I'm going to be honest with you, I rarely ever traded ETFs just other than recently, because it's like, an ETF back in the old days, everybody remember, was just a basket of stocks. Now they're making I think Tesla has, I don't even know how many ETFs they have. Probably like maybe 100, maybe more. I mean, there's just so many of them out there. And then they're making ETFs with an ETF with the options, with the high yields, which is like, I mean, they're all new and they're just like, it's just like, it's endless. But it seems like there's more and more coming out, and I don't know what's going to drive the market down when they just keep coming out with all these new stocks making up all these new ETFs.
Yeah, no, I appreciate that perspective because, again, I mean, certainly, Gav sees it in his world, and just the types of things you can trade are it's mind-boggling what's hit the tape lately.
Yeah, we keep on seeing more and more. We do a lot of shows throughout the week. We do a weekly show with YieldMax. We do shows with Neos. You have Curve. You have everybody, and right now, it's more of a volume game from what I'm seeing, right? Get as many as you can out there, have as many different assets, let retail pick them up and begin to run with them, see if institutions will come in and start putting money in. You can go pretty quick to $1 billion in assets from what I've seen on a lot of these firms. It's insane.
Jason, I want to go to you again, that since your world is sort of tracking institutional money, what the big money's doing, retail is obviously a big factor in this market, but that's where you tend to get those sort of long-term trends that just keep going and going and going. You briefly touched on a few sectors where you're seeing some opportunity. Can you expand on that? Maybe whether it's sectors, whether it's an ETF or two, or a stock you want to throw out there? I'll kind of leave that up to you.
Sure. I'm going to try and share my screen here again, and we'll hop into, Money Flows has a software-based platform. We call it the portal. Hopefully you're looking at my screen right now, but
We got it.
we're all about money flows. So this amber line is our big money index, and that shows when money is flowing in or out of the market. We've kind of had this sideways action since August after a little ramp up. Really what that helps us identify oversold markets down here in the green, which we haven't seen. April came close. Overbought markets, which we usually get a bit of a sell-off and outflow. But this is all driven by flows. So if we look over here at the actual daily inflows and outflows, what you're looking at is the blue area is the SPY. That's the S&P 500 tracking ETF. And we're looking at the algorithmic representation of amounts of stocks that are bought or sold in an unusual way. So, accumulation distribution. And what you can see clearly over back here in April, this was the panic from the Rose Garden, Liberation Day. And then basically you get this big spike here, May 12th, when Trump delayed tariffs. And it's been game on ever since. Everybody buying everything. And to your point, how do we see which sectors are showing us where the money flows are? Well, we look at our sector ranks right here for today. It's technology. This has been the top ranked stock. If I go back here since May of this year, what we'll see is that the largest amount of inflows, unusual volumes. This is institutions buying things in an unusual way where they have no choice but to impact the shares. It's been technology. And then, we can go down here and we can look at our technology sector, and you can see clearly that there's just been a ton of inflows moving in, driving the sector higher. What we're seeing within that sector, software, semiconductors have been on fire. If we go back over here and we look at industrials, that's been a really strong sector as well, collecting these inflows, way more inflows than outflows. You see, this is mapped against the sector index ETF. Looking at another one, financials has been very strong. Obviously, as rates come down, there might be more M&A. You can assign your story. Whatever the story is, we're seeing huge inflows into this sector. And last but not least, discretionary is an area, and that was the one that popped up first.
Yeah.
Again, healthy amount of inflows. And, at Money Flows over here, we can drill down further into the individual stocks that are ranked the highest, seeing the money flows. So, the narrative can be whatever it wants to be. What I tend to see is the big bearish doom and gloom headlines is a great way to attract attention for a media-driven business that survives on advertising. If people aren't looking at their advertisements, advertisers aren't going to pay. Right now, what big money and institutional flows are showing me is that there's a risk-on appetite, and it's driven mainly in small and mid-cap stocks.
Appreciate that, Jason. Honest, I want to go back to you because, we've talked a lot in the first part of this program about kind of big picture and setting the stage and what's been happening in oil and other markets. But I want to maybe talk a little bit about opportunities. If an investor is listening to what you have to say, and I know from in the past, maybe you've talked about LNG and that is an opportunity. Can you talk a little bit about maybe some trends in energy that you think could be promising if an investor is looking for some place to invest in that part of the market?
Generally speaking, you are right about LNG. The demand for LNG is going to skyrocket over the years, and we might end up with a situation where the global trade in LNG is bigger than the trade in oil, and the trade in oil is the largest trade in the world. So LNG could be really the biggest trade ever. The demand for natural gas is very strong for several reasons. And one of the main reasons, of course, is this massive increase in energy demand fueled by urbanization, fueled by immigration, and fueled by AI. And one item that usually people forget is that with the increase in income in poorer countries and the creation of middle class in the emerging economies, the increase in income leads to something kind of very interesting, because people, when their income increases, they don't like wear double the clothing or eat lunch twice. They spend the extra money on comfort. And it just happened that one item out of that comfort that is very important to everyone is air conditioning. And air conditioning basically is a main driver for energy demand worldwide. And now we've seen this in China, and we're seeing it around the world. So you add all of those together with AI and data centers, and you see where energy demand is going. Why this is important? Because those who advocated for climate change, their objective was to eliminate dependence on coal completely and reduce dependence on natural gas. Now, this is not going to happen because of this massive increase in energy demand is not going to happen. And therefore, the demand for literally what they call fossil fuel, well, I don't like this term, the demand is going to be way larger than forecasts. And this is important because most of the future investment is based on forecasts. So if the forecasts basically are not there, then the investment is not going to be there. Then you add to it the fact that we have a retreat from climate goals all over the world from governments and companies. We are seeing it every single day. And between the increase in energy demand, the retreat from climate goals, and the failure of some government policies when it comes to green energy, the only energy source by default is natural gas.
Yeah.
And
thank you. Appreciate it.
We cannot transport natural gas across the ocean, so we do the LNG. And that's why the demand for LNG is going to skyrocket.
Perfect. Thank you, Anis. I appreciate that. As you probably saw again on the crawl on the bottom, orlando.moneyshow.com. That's where you can go check it out. Or, and again, we do early bird pricing through the 2nd. So that would be tomorrow. If you want a standard pass, now's the time to get one. You can also, if you want to check it out and you sort of kick the tires at Money Show, you can get a free exhibit hall pass. It'll have you a chance to see some of the stage presentations, wander the booths, listen to some, or follow in or watch as we do some of our Podcasters Corner broadcasts and recordings there. It's a lot of fun. I guarantee you're going to have a good time and you're going to learn a lot. So that's part of the fun. Jonathan, I do want to pivot to you. And, we talked about foreign markets. Talk about some of these.
I've got one for you, actually.
Oh, perfect. All right. Well, there you go. I can shut up and let you talk.
What always interests me, and I respect all these gentlemen's perspectives, and what's so important, I think, about the Money Show is that it helps each of our attendees become better investors for him or herself. And, you got to come up with a strategy that works for you. So you listen to a lot of different perspectives and find something that works for you. Something that always kind of attracts my interest are assets that are doing well for which there isn't a major interest. There isn't 10 new ETFs being thrown out every day. And one of which has to do with Africa. Now, I thought Africa was just a song by
Toto. There we go, right?
Turns out there's a real continent. I'm joking, of course. No, Africa is a perfect example of under-owned, underinvested emerging market that's been tossed away after many, many years of underperformance. But AFK is an ETF that has a basket of African stocks. Again, do your own due diligence, talk to a financial advisor, but it's at a 20-day plus high. And that's what I'm always looking for, something that's doing well, but that I think for most people, if you said, hey, can I put 20% of your 401k in an African ETF, they'd say, you're crazy. You're on mushrooms. But once it's up a couple of years, once emerging markets have outperformed, then they're going to call me and say, gee, don't you think we should be at some more emerging markets? They seem to be doing well right now. So, follow the market, as many of our panelists have talked about, and the fact it's doing so well is reason enough for me at least to take an initial position.
Great. Thanks, Jonathan. Appreciate that. Peter, I'm going to go to you because you've talked about foreign markets, mining stocks, some of these assets that people haven't really owned much. And that in the case of mining stocks relative to the S&P, the market capitalization is just a small sliver of that. So what are when you talk to people, what are you recommending besides owning physical metals, for example?
Well, I've been recommending foreign stocks for quite some time because I've been, very ahead of the curve in anticipating what is about to happen. But one of the things that foreigners have done with their surpluses with the U.S. as they've invested in U.S. financial markets, our stocks and our bonds. And that's been driving a lot of the outperformance has been foreign investment into our markets. And I think that's being reversed now. And I think we're going to see for many, many years outflows. I think foreigners are going to be liquidating U.S. stocks and bonds and bringing their money home because the valuations are much better in their local markets. And now so too are the returns. I mean, our largest global strategy, which is the global dividend payer strategy, and I also have a dividend payer fund, we're almost up 50% on the year after 3 quarters. And these are dividend paying stocks. This is not, momentum tech stocks. This is a pretty conservative portfolio, and we're, 50% year to date returns. I think maybe 48, something like that. And I think this outperformance, because that's about triple the S&P 500's return for the year. And I think the weak dollar is going to create, a huge tailwind for overseas investments. And, right now, year to date, if you're a European and you're looking at the S&P, it's barely up in terms of euros. And that's the currency that you're looking at. So foreigners are seeing very lackluster returns now in the U.S. because of FX losses. But I think next year, Americans are going to start looking abroad because the weak dollar adds to the returns on foreign markets. So maybe if you're in Europe and you're looking at returns of 20%, an American looks at those same returns, they may be 30, 35% based on the weakness of the dollar. And so I think the first thing you're going to have is foreigners pulling their money out of the U.S. to reinvest in their own local markets. But then you're going to have Americans taking money out of the U.S. market and sending it abroad in chase of better returns that you can have in overseas markets. And again, we haven't seen that since the early 2000s. I mean, that's when you had much better performance of foreign markets, 2001, 2, 3, all the way up to probably 2011. You had foreign markets, emerging markets, commodities did great. And then that all stopped around 2011, 2012. And the U.S. market, was the only game in town really until this year. Although last year is when we really started to see the strength in gold and this year in the mining stocks. But I think both of those trends are going to continue for the rest of this year and probably for the rest of the decade. You're going to see this incredible outperformance. And if I'm right on the massive inflation, I mean this is stagflation heavy. People are saying, well, maybe it's stagflation light. It's going to be way worse than the 1970s. And the main difference is we were in much better shape back then, financially as a nation. We were still a net creditor nation. We had trade surpluses, and we were able to put a stop to the inflation of the 70s with 20% short-term interest rates.
Yeah.
Now, the country is not in a position to afford that now. So we can't afford to cure inflation. So we're just going to die from the disease.
Well, I'm going to, you've talked specifically about the risk in the dollar falling, therefore creating a problem in the treasury market, interest rates go up and so on. So we've talked about that one big picture risk. And I have a couple others I want to throw out to the group. But before we do, I do want to get to you, Fausto. I wasn't sure if you were trying to share a screen or a chart there. Anything that for somebody watching this, there's something particularly attractive on your screen that, more than obviously just a day trade, it might be something you're looking at for a few weeks, month, whatever.
Do you want me to pull up the screen?
Yeah, put it up. Let me show. I want to show something pretty cool. So obviously you heard what happened yesterday where Trump said something about Pfizer. Pfizer going to be giving away, I don't know how they can do 100% discount on medication and drugs and stuff. But Pfizer took off yesterday pretty big. And I just want to get to show you, this is what like us day traders kind of look at. Sometimes, you don't have to look at the long-term effect, but you look at the short-term, that news basically ran the stock up from about $23 to $27. But what I want to kind of point out here is that a lot of people don't feel like they have to learn certain indicators and don't realize indicators are lagger. Like one thing that I like to focus on is as a high frequency trader, I look at the algorithms and the dark pools. And what you see here is that the stock right here, and this goes with every stock, this stock right here, just Pfizer, people want to wonder, like, why did it stop here around the $27? This is something I'm going to be teaching at the Money Show. And in Toronto, I was up there in Toronto showing it. Long-term chart, you can see right here, the stock basically stopping at these resistance around 27. Now, what makes a resistance, just want everybody know, is that it's sellers, all right? And a lot of people don't think that, they think that the past is always going to indicate the future. But the only way to see that is something called level 4 we kind of use right here. And if you look right here, you could see that there's been a lot of program trading. If you look right there, you see a little red line right there? That red line right there, if I move over here a little bit, that was an order that got filled. It was about 142,000 shares that were out there looking to be sold. So when you out there and trading, you know, if it's gold, if it's anything, if it's Bitcoin that we trade, you know, one of the big things that you kind of look at is that look at the right of the chart, and the right of the chart are the high frequency trades. These is where the institutions are, and this is where the orders are. Intel, like I talked to you earlier, there was some big news that came out on Intel, and Intel popped, but it's got some big resistance here at 36 because there's a 300,000 seller. I know we have a couple of big fans out there that are looking at NVIDIA. I just want to give you a heads up on NVIDIA because NVIDIA is a really good one too. NVIDIA had a really, really big resistance at 185. But if you really want to know where the orders are, you got about 1,000,001 share out there at 200, and another about 900,000, 680,000, 90,000 at 190. So, you know, there's always opportunities out there. So if you're finding stocks, like one of the big things that we kind of teach you here at the Money Show, is that as much as you're trying to like analyze certain stocks and want to see, you know, what's going to happen in the future, well, kind of focus on some of the big orders out there, and that will kind of lead you where to get in, where to get out. Because the big problem people have is they just don't have a game plan, and and the biggest problem people have is they just don't know how to take a loss. So the biggest thing is you got to follow the trend, and you know, when you see those big orders out there, just makes your life, gives you more reasoning where to get in and where to get out. And that pretty much does it.
No, I appreciate that. Look, again, we have speakers on here that are big picture macro, sector specialists, micro, day trading. We're trying to cover a little bit of everything, which, like you said, that's sort of what we do when we're on site at our conferences, including Orlando, October 16th to 18th. There, I said it. Now I'll get a pat on the back for that one. In any event, I do want to kind of talk about a couple of the risks. When I look at, you know, what a market coverage, when I kind of think about what are the things in the back of my mind I have to think about and not necessarily worry about, but keep in the back of my mind. Look at the sort of the AI boom versus bubble debate. I mean, the Wall Street Journal had a story the other day. Is any of all this AI investing going to pay off? It was a whole long thing about this place in North Dakota and how they're, you know, and all the stuff related to it. So you had that. You had another story about private credit and, you know, are people, these couple of bankruptcies we've seen, is that going to be an issue for non-bank lenders and all this lending risk that's off bank balance sheets, unlike last time in the housing and mortgage crisis? Any thoughts on that? Are these things we need to worry about, not care about? You know, I feel like we got to give risk at least a few minutes here on the stream. This is sort of an open one. I'll just toss into the crowd.
Yeah. Well, I'll quickly just jump in. I mean, I think that the concentration in so-called AI plays. I mean, we're at the point now where a company just needs to announce some kind of an AI association. I forgot which was it yesterday, maybe Spotify, and it, you know, gets a 5 or 10% pop. And the fact that President Trump announced this program to basically print $1,000 to give every newborn a stock portfolio, that could only happen in a bull market. I mean, in a bear market, no one would say, "Oh, let's put money in this." They'd say, "No." So, you know, they don't ring a bell at the top. But
that's not a bad idea, Jonathan. I wish I had $1,000 when I started.
You know, in a bear market, they say, "Oh no, it stays."
Yeah, you know, it's a lousy idea because the government has to go into debt. It has to borrow that money, and so the kids that are getting the stock are also getting the debt. Because, you know, rather than doing that, why don't we just start paying down the debt? That would help the kids better than giving them money in a stock portfolio where they might end up just putting it in meme stocks and Bitcoin treasury companies and have it all blow up and go to zero.
Yeah, I get the worst of both worlds. I don't get the $1,000, but I get the debt.
Yeah, but look, this is the big issue. You know, the market is extremely overvalued. The economy is on the verge of a massive, stagflationary collapse with a currency crisis and a sovereign debt crisis. And, you know, everybody wants to celebrate the record high in the Dow Jones. You know, to put it in perspective, I think the Dow is down 25% this year in terms of real money, which is gold. But, you know, you go back to 1929 peak for the Dow, the Dow was worth 19 ounces of gold. Today, it's worth just 12 ounces of gold. So over 96 years, the Dow has lost a third of its price, right? Obviously, if you've owned the Dow Jones for 96 years, you've made a lot of dividends. But if you just look at the price, it's down significantly. And inflation can create the illusion that we're getting richer, but we're not. In fact, the U.S. stock market has been in probably the worst bear market in history for longevity, because in the year 2000, the Dow was at 40 ounces of gold. So it's down 70% in 25 years. And it's ongoing. I think that before this bear market ends, you'll be able to buy the entire Dow Jones for less than 2 ounces of gold. And so, that's really what's going on. Americans think they're getting richer, but they're actually getting poorer. And that's one of the reasons that the government creates inflation, because it makes you think that a bad economy is good. And that's the reason that Donald Trump got reelected, because everybody was pretending that we had a good economy when it was just inflation. We had a lousy economy. In fact, that's why Trump won the first time, because the economy was actually bad under Obama, and everybody tried to convince us that it was good. And that's why, the next president is going to be a radical left-wing Democrat, because the economy is going to be so much worse at the end of Trump's term than it was when he began, that the public is just going to, try again to change horses and go for whoever's not in power. Because it's going to be very easy for the Democrats to blame everything on Trump.
I got to steer this back and I appreciate the perspective, but I got to steer this a little bit back to the AI thing, and that Jonathan, the point that you were making there, and the sentiment issue. I mean, which I guess I also want to throw to you, Jason, before we run out of time, is with your indicators, how do you know, what do you see that says sentiment goes from, holy cow, this is a great, powerful trend, to here's a couple of things that are worrisome, and that maybe some of these back of the mind pictures are moving to the front of the mind?
Yeah, I think that's a great point. We're kind of surfers. We surf the wave. The hurricane of all hurricanes may be coming, as Peter's alluding to, but we're riding the wave. So if I share my screen, the biggest and most accurate indicator that we have is the big money index, and that's just a market-wide money flows index. And probably the easiest way to illustrate this to everyone is going back to COVID land. And if we look, what we see is when this indicator goes overbought, that's when we at Money Flows are telling, by the way, the current indicator is not overbought. It's not even overheated. It's actually dropping a little bit. Nothing to get nervous about. But when we go overbought, we're not telling people to run for the hills. We actually wait till that indicator falls from overbought, which is right here on January 29th of 2020. And what that indicated to us was that large institutions were reducing risk across equities. But what did we see? For a remaining month, we saw the S&P rise while the big money index falls. Now, we didn't know that COVID was going to shut down the world and cause a once-in-a-100-year pandemic and crazy work at home and all those distortions that we saw. We just told our customers, hey, our readers, 79.3 today, it fell from overbought. It's time to reduce risk. And then the opposite indicator, Mike, is when things get totally, everybody's in despair. It's doom and gloom as far as the eye can see. Everything's negative. We go oversold. That's when we're telling our clients, hey, this selling, this distribution, this level of insanity is unsustainable. And we're coming out with beaten down sectors with high scoring fundamentals. And that caused this rocket. Now, a last point, why you don't want to exit the day we go overbought is case in point here. We stayed overbought for 87 trading days. And then we fell from overbought and started to get this downward pressure in the SPY and sideways for a while until money started flowing back in. So that's our biggest indicator.
Well, I appreciate that, and I would love to keep this discussion going for another hour, but I know Gab has some other things he needs to take care of, as do all of us. So I do want to kind of get to the point where I'm wrapping things up. everybody, Jonathan, Peter, Jason, Anis, and Fausto, I appreciate you taking time here to join us, do this. Hopefully everything worked well. The technology seemed to work pretty well for a first time through. So no matter where you watch this, thanks for joining us. As a reminder, if you came on late, every single one of the people here is going to be speaking at the Money Show Traders Expo Orlando, October 16th to 18th. We're going to be at the Omni Orlando Resort at Champions Gate, which if you've been there before and you like golf, you're going to have a great time. If you haven't been there before and you're coming from like that part of Florida, it's great because you don't have to drive through the middle of Orlando and all that traffic. So in any event, we hope to see you there. Early bird pricing lasts through tomorrow. So definitely click on that link that you saw earlier or go to orlando.moneyshow.com. Check it out. And yeah, great conversation. Thank you again, Gav. Thank you for hosting this. Had a wonderful time.
Yeah, my pleasure. Thank you so much to everybody that was on here speaking. Really appreciate you. Just a wealth of knowledge. Would love to have more of y'all coming back onto our shows. I see on the Wolf End, we had around 7,000 people tune in this hour to listen to this. And then I know went out to several of your channels as well. I know we have a live stream coming up in 2 weeks here that Peter's going to join me for. We're going to really dive into gold. And I would extend the invite to the rest of y'all if we want to set up more conversations like this to talk to the audience and continue to educate them. Great point there, Fausto. It's all about the learning side, especially in a market like this, right? You want to be learning every single day. So huge thank you to everybody. Appreciate the audience for tuning in. We got some great comments as well. I thought there were some fun ones. I thought this was one of my favorite ones. So shout out, Fausto. You've got the loyal audience, the man, the myth, the legend. Some other comments as well throughout. People were just loving Anas as well. You had some people coming in calling you a legend as well. So thank you to everybody. And, just this one sums it up. Great panel. Take care, everybody.